When it comes to buying stocks this year, the idea of do what you say and say what you do isn't playing out in the actions of young investors. CNBC's senior personal finance correspondent Sharon Epperson is here. She joins us now with the results of a new and maybe surprising survey released this morning.
Yeah, Andrew, it's quite surprising, actually. Bankrate finds that younger investors claim they're going to invest more than last year, but in fact, they're doing exactly the opposite. More than half of Gen Z and 43% of millennial investors say they expect to put more money into stocks in 2023, more so than Gen X and baby boomers. But here's what they're really doing.
What we see among younger investors is a much higher propensity to have been taking action so far here in 2023 in the face of things like elevated inflation or the higher returns that are available on safe haven cash investments. And there was an increased likelihood of selling or withholding investment rather than buying in response to that.
The survey shows that almost half of Gen Z and a third of millennial investors sold stocks or didn't buy more this year due to elevated inflation. And 38% of Gen Z and 33% of millennial investors sold stocks or didn't buy more due to higher returns on safe haven investments like savings accounts, money market funds, CDs, and government bonds. Financial advisor Jordan Owoye says many young investors are tapping stock-heavy retirement and brokerage accounts for everyday expenses.
For a lot of them, that stock market account is not necessarily that set it and forget it that their predecessors have been taught. A lot of them are using it pretty actively and treating it as like a savings account plus.
They may be using that money to pay off credit card debt, buy real estate, or invest in their own business, but they're not leaving it there in the stock market, Andrew.
So how are they taking money out of their retirement accounts to do this, though?
Well, a lot of them are going into their 401k. In fact, Voya found
at a loss.
At a loss and at penalty and taxes and not thinking about all of that. A lot of surveys have shown that if they don't have an emergency savings, they're much more likely to tap their retirement accounts for hardship withdrawals they may be able to take. But then taking out 401k loans is seen as, oh, that's okay because I'm paying myself back. But if you miss one of those payments, once you set up the repayment schedule, it's a distribution.
How broad is this? I mean, do you think there's a whole generation that's doing this? Or this is just a...
Two out of five Americans, according to a Voya survey, were going into the retirement savings if they didn't have any emergency savings. So it all comes down to having that emergency fund. If you don't have it, the biggest part of your money is retirement.
They're not blowing it on experiences. They're never going to get old. You know that. They're going to live these millennials.
But it's interesting. That whole idea of keeping it in the market for 10 years
from the apples.
Yeah, they're not.
Is this different than previous generations at that age, though?
Yes.
I think so. I think so.
Totally different.
I think so. I
don't know. They're entitled to everything. Why do they need to save?
Well, I think they're looking also at other types of ways to make money, trying to think, well, if I have my own business, or I'm going to put the money into my own thing and then launch my own business, or I'm going to buy real estate, or, there are other ways that they're looking at trying to invest and grow their money other than keeping it in that 401k or an IRA.
The parents are going to cover it.
Sharon, thank you.